Hey, good evening, guys. Welcome to the podcast. Thanks for joining me. Well, the stock market was down today, and not a big shocker. I think, and the market's been as good as it has for as long as it has. When we do get a down day, everybody starts talking about, is this the end? Is this the, is the rally completely over? And it ebbs and flows, and we are now moving perhaps from ebbing to flowing. But really what started it, I think, really the market had some excuses for going up today, but in fact it went down. And in case you missed it, the Dow Jones finished down pretty much on its lows of the day, down about 153 points, almost 1%. S&P was down 1.3%, and the mid caps and small caps were down 1.8%, and then the NASDAQ was down 1.9%. And so the kind of the riskier it was today, the worse it got hit. On the upside, bonds got some relief. The VIX, if you own the VIX, you got a nice pop, which we'll go over in just a minute. I'm going to try to get this all in as quickly as possible, but we saw a few warning signs the last few days. I put out on Twitter a couple of days ago that we were indeed short the Russell 2000. We own something called RWM. Now, keep in mind that I owned this a few days ago. We bought it a few days ago simply for our aggressive strategy because we have more stocks in there, and this was to hedge those positions that we knew we were going to keep if the market did indeed sell off. So we looked at it and said we were going to have a tight stop in case the market kept going up. But what this is, it's an ETF that shorts the Russell 2000. So we wanted to pick small companies because those were underperforming, and they've been underperforming. And remember, we want to see financials, semiconductors, small companies, tech companies. We want to see those outperforming the general market. And what we've been seeing lately is underperforming. So there were some signs that perhaps we were getting a little frothy and due for a little pullback. So again, in our main strategy, we're pretty heavy cash in certain areas. In fact, we have an ETF rotation strategy where we kind of stay in some of the warmer sectors and try to avoid the weak ones. And in that model, we've been 75% cash for, probably a week or so, and 50% cash for a little longer. And so that's pretty heavy cash. And then in our aggressive strategy, we've got this short position to kind of offset. And so it was up nicely today, almost 1.67%. We try not to use the double and triple inverse ETFs simply because they have this correlation problem where the longer you hold them and they rebalance daily, you get some distortions. And so we choose to go with the 1 times inverse. So this simply moves 1 times opposite the Russell. So the Russell is down 1.78. This was up 1.67, pretty closely matched there. And but getting back to the market here, we have again, and we've pointed this out what seems like months now, this zigzag pattern, right? And the 100-day, which isn't followed a lot, but the 100-day moving average, which is the purple right in here, has been support for the market. And again, we bounced, came back to it, we went up, and look what's happening. Now we're coming back down. So again, what's logical? This is going to continue to move up. And so 1700 is kind of looks like your place where all this is going to come together. So it wouldn't surprise us to see the market come somewhere down in here and bounce. Now, at some point here this year, you're going to see the stock market sell off more than people believe. In other words, you're going to see the stock market go down and come down to this purple line, and there's going to be some people buy it and go, yep, same old pattern, and it's going to turn back around and head back down, and then the 200 is going to come into play maybe, or maybe it even breaks below it. I still don't know if that's going to be the end of this. I think the odds still favor a strong market going into year end, but here's what's happened the last, let's say, couple of weeks, and we've pointed it out here before. You have seen a rotation from the growth type investments, right? The things that would benefit from a very strong economy into areas that would benefit from a weak economy. So when you take a look at, and again, today, pretty much everything across the board was down. But what held up on a relative basis okay were things like healthcare, insurance companies, utilities. Those held up a little bit better. Not much today, but in the past, what you've been seeing is those types of companies have been outperforming things like financials and technology, certain areas like that. So we had exited our technology holdings as far as our ETF basket, our rotation strategy, we call it. We exited that last week, I believe. I think it was last week, or maybe it was Monday. I can't recall. But anyways, it was earlier in the week, and at the same time put on that short position again on our aggressive strategy. And so we've seen that rotation. So the market was already signaling that, hey, it was taking some risk off, even though the Dow Jones made a new high yesterday. And that was the other thing that caught our attention, was that the Dow Jones made a new high yesterday. And what happens is, again, riskier, smaller companies are going to sell off. And if people are going to hold stocks, they're going to tend to gravitate towards the largest, biggest blue chips. And if you go down the Dow, there's a lot of cheap companies. Probably the cheapest companies are on the Dow. Now, they don't have all the growth in the world, but they've got good dividends. They're relatively inexpensive, and that's where people tend to flock when they're scared. But what happened today was we had a couple of things going on. Before the market opened, we had the ECB say they were going to cut interest rates from 0.5% to 0.25. And you may say, well, that's not a big deal. Well, it was a big deal because nobody anticipated them doing that. Out of like 80 economists, I think 2 had predicted, or 4, that they would actually do something like that. And they did cut. So they're worried about growth slowing down. The Fed, obviously, here in the United States hasn't tapered because they're worried about growth slowing down. And so what happened was, and this is a 5-minute picture of the euro based on this ETF. So here's the close from yesterday. So you can see this gap down. It closed at 133.75, opened at 132.25. And again, you're going, well, that's not that big of a drop. It's only like 0.75%. In currencies, that's a big drop. So once that happened, our stock market shot up in the pre-market. You may be wondering why that is. Why would our stock market jump up? Well, it's because, again, investors are addicted to free money, low interest rates. But what's happened is, think about it. These central banks, our central bank, the Federal Reserve, the European Central Bank, and all the other central banks around the world are destroying their currencies by continuing to keep rates low. And that's what happens. It's called the race to debase. It's the race to debase your currency. It's a currency war. Who can have the cheapest currency? Because they think that's going to help things out. And in the meantime, all the currencies are getting cheaper. So the stock market initially jumped on that out of the gate, was up about 80 points, I think, on the Dow. S&P was up somewhere around 6 or 7 points. And we didn't take any action because, again, it nothing really changed in our mind. And what happened was, lo and behold, the stock market sold off, had a little bounce, but sold off pretty much the whole day and closed on its lows. So kind of faded that. The bond market is really the thing that has been interesting, because the bond market, if you look at 10-year Treasury rates, remember we talked about this kind of pattern they have been in where, let me go back a little bit to May, because May was really when things started to ramp up as far as rates. So rates went straight up, and then the kind of the rate at which they were going up kind of slowed down. We started to roll over. We gave back part of these gains. We came to this, what this is like, a support level here, kind of bounced off it. And so, again, either we were going to break through or roll back over. And we did break through a couple of days ago. And we actually, on our income strategy, we actually put on a position and shorted treasuries because we feel like they may continue to go up. What we're going to do, though, is watch it. It's a very small position, but it was to hedge those income-sensitive things that would get hurt on a day where rates went up. And so we actually are put on a position that would benefit from rates going up. They didn't. They went down today. And so that's one day, but we're watching this carefully because it's at an inflection point right now where it's either going to go down past this old low and break this, or it's going to pause and head back up. Now, those that think the economy is slowing down, that means interest rates will come down. But also, here's the thing. Interest rates can come down just because of the fact that people are scared of other assets, right? They're scared of the stock market today, so they go into bonds. So, but you definitely, this interest rates going down confirms that people have been scared of the economy slowing down lately, and that's why you saw the ECB said they're concerned about it. The Fed not tapering says they're concerned about it. Utilities and healthcare companies going up and bonds going up and gold holding up better. Those are all things signaling that growth may be slowing again, and people are concerned about that. We could predict what we think is going to happen, but what we like to do is look at the market and say, what is the market telling us? What's being priced in? Because I can have a theory on what I think is going to happen, but I'm not an economist. Not that they, in a lot of cases, are very useful anyways. But we want to look at the market and say, what's going on? We know that oil has been going down, right? Oil has been one of the things that has been signaling that perhaps instead of worried about inflation, we should worry about deflation, right? Oil's been falling from $110 a barrel to sub 95. But now it's in this zone, this yellow zone, where if we go back a little bit, it should get some legs here and bounce. Even if it's a, we'll call it a temporary bounce or a reversion to the mean, it wouldn't surprise me to see oils drop $15. It wouldn't surprise me to see oil bounce somewhere back above 100 and maybe somewhere in the $100 to $103 range, even if it's going to continue lower, to have some type of bounce. But overall, you did see this rotation out today in the overall stock market, and certainly out of some of these commodities, especially because the dollar was stronger, right? Because the euro got crushed. So again, this is the thing that we're watching, is really the Russell 2000. Again, this purple line, similar to the S&P, has acted as support along the way. And so we extend this out. It wouldn't surprise us to see it get down somewhere down to here, and that would be the first test. So if you have some investments, longer-term investments that aren't for trading but are investments, not that you would keep them to the death, but investments that you're not going to get shaken out by one bad day or two bad days, then you've got some time, because nothing has changed this picture here. This picture is still intact, okay? That picture is still intact. That trend is still intact. So, once we start breaking these lines and we start breaking this line, then that's when you need to ask yourself, okay, something has changed. The character of this market has changed. We're not there yet. If you want to be early with some trades, that's one thing. We've been taking some profits on some individual positions. I mentioned that we had sold our junior gold mining shares a few days ago. We actually sold a big portion of an industrial company that we owned that had some unbelievable earnings, but very cyclical type company. So we shaved that down quite a bit, locked in a really nice profit, because we wanted to keep the position, but we want it to be lighter, because if the market's signaling less growth here, economic growth, even if that company is doing fine, it's going to get hurt. And sure enough, it got hurt today. So we own a very small percentage of it at this point and locked in some profits. One of our saving graces today, besides having a short Russell 2000 position on in our aggressive strategy, was we have an internet travel company that books different places you can stay. And monster earnings, very fast-growing company, very volatile company, but it was up about 16% today. And that helps on a day like today. But overall, there weren't a lot of places to hide other than treasuries, and that's kind of what's scary, is because remember in 2008, where was the only place to hide? Well, there's two places: cash or treasuries. And so if you look at the TLT, which is treasuries, does this look like it's bottoming, or does it look like it's just bouncing temporarily and it's going to fall further? I don't have an answer. That's why we're being flexible with it, because it could very easily head one direction or another. Remember, we got a jobs report tomorrow morning, and when it comes out, that's going to really move interest rates one way or the other. If it comes out weak, all this trade that happened today is probably going to get confirmed. But if it comes out really strong, the stock market's really the thing that's difficult here, because the stock market isn't just about the economic data, right? If this economic data comes out very strong, bond interest rates are going to go up. But what happens if the economic data is strong tomorrow? What does the stock market do? Does it go up because it's great, the economy's still rip-roaring? Or does it go down because the Fed could taper sooner than later, right? That's the big risk to the stock market right now, is that the Fed is going to taper sooner than people believe. But let's see what the data suggests here. So, it's confusing right now, but in general, there's been some signs to be a little more nimble, lighten up on some things, and if you own stocks, shift to more of the utility staples, healthcare type companies, and get out of the really go-go type stuff, because a lot of the Momo type stocks, these very high velocity stocks have been hurt very badly lately. When you take a look at something like a Tesla, which has been a unbelievable stock, this looks broken, doesn't it? Does it not look broken to you? I'm not saying that it's not going to stop at some point, because it's a very strong company, but if you're trading this on momentum, the momentum is broken now. So, now you need to start saying, okay, you need to start figuring out some different levels that it could fall to and start drawing support. Like, this is actually a support where it is right now. Next would probably come down here to this old low at around $110, and wouldn't surprise me to do that. And the key to this is that look at the volume down here. So these stocks that have been working are getting hurt right now, and they're going down on heavier volume. So that tells you that there is a little sea change going on, okay? So be aware of that. Well, the big IPO today was Twitter. It went public. Here's a 5-minute picture of it. It was pretty interesting. I watched the process of how it unfolded. Very smooth. The complete opposite of the Facebook IPO. They took their time putting it out on the market. There was about a $5 spread. They got it tighter and tighter and tighter until they got this nice balance. Remember, the IPO price is 26. It came public at 45 and I think 45 and change maybe. It went up. It worked its way over the next 10, 15 minutes up to about $50. Came right back down and then never went below that kind of initial price, and had a nice ramp up into the end of the day, and then, of course, sold off right just below actually where it kind of opened up. So all in all, people that got it at 26 had a great day. People that bought it at 50 had a bad day. People that bought it at the first tick are basically flat. And it's an expensive stock, but I think it's a stock over time that is maybe even probably similar to Facebook in the sense that every large tech mutual fund is going to own it. Even though it's expensive and it's overvalued, they're going to want to own it. So what's happening now is you're going to see people that got in at the $26 level, they're going to be selling it. And so you got this selling pressure kind of battling the people that want it. And that's what you saw today. But overall, not that volatile today. It was much less volatile than I would have thought. I would have thought we would have seen $60 today. Which is crazy as that sounds. The stock was still up, 26 to $45. It was at one point almost a double. Finished up probably 60 or 70% on the day. But this will stabilize a little bit, and I can't analyze it right now. I think it needs to find where it's going to trade, what kind of premium. But we know this is a very expensive stock, and they don't make money. But guess what? Amazon doesn't either, and that's been an unbelievable stock. So anyway, it's just worth mentioning. It was a smooth IPO, but they left a lot on the table, didn't they? Because it basically opened up at $45, and the initial public offering was 26. So, all right, guys, have a great evening, and we'll talk to you soon.